Hey everyone, and welcome. I am absolutely thrilled you're joining us today because we're jumping straight into the official scheme information document for a really fascinating financial product, the Edelweiss BSE Top 10 Bank ETF. If you've ever wondered how the mechanics of a specialized exchange-traded fund actually operate under the hood, well, you are in the exact right place. We're going to unpack the literal blueprint of this passive banking fund. We'll take all that dense regulatory text and transform it into a clear, structured, and completely easy to understand journey. So let's get into it. Okay, let's dive right into our roadmap. We're covering the fund's main objective, its core passive strategy, what's exactly inside that top 10 index, the mechanics of trading, and finally, we'll wrap up by understanding the risks.
Kicking things off with Section 1, the fund's main objective, mirroring the market.
You know, every financial product starts with a foundational goal. For this ETF, it's strictly to generate returns in line with the BSE Top 10 Bank Total Return Index, subject to tracking errors. That's it. It's absolutely not trying to find hidden gems or somehow beat the market. Its solitary goal is pure replication of those top 10 banks, exactly as dictated by the index.
Moving right along to Section 2, the core passive strategy, the engine.
So the core engine here is strict passive management. Think of it like a giant mirror. The asset management company makes zero active judgments on the investment merit of specific banking stocks. There is absolutely no market timing and no temporary defensive positioning if the banking sector takes a hit. The indexing approach strictly removes human bias and active forecasting entirely, moving precisely in tandem with the benchmark.
In practice, this means a massive 95 to 100% of the fund's assets are fully deployed right into the securities covered by the BSE Top 10 Bank Index. That tiny little 0 to 5% sliver you see from money market instruments or cash, that's strictly a buffer for everyday liquidity, basically just handling redemptions or minor fund expenses. The vast, overwhelming majority of the capital is always fully deployed, literally just mirroring the banking index.
Now, what's really interesting is Section 3. Inside the top 10 index, the building blocks. Let's open up the hood.
Looking at the actual index constituents as of June 2026, we see a pretty steep hierarchy. HDFC Bank dominates the top with over a third of the weight, followed heavily by ICICI. Then we have mid-tier allocations going to Axis, SBI, and Kotak Mahindra, tapering all the way down to smaller footprints like Federal Bank and IndusInd Bank. And remember, the fund manager's only job is to just maintain this exact ratio.
When we isolate just the top 3 holdings, a glaring reality of this passive strategy emerges, and that is concentration. Look at this. HDFC and ICICI alone make up over 54% of the entire index weight. So while you're technically diversified across 10 stocks in theory, more than half of the ETF's performance is driven by just 2 banks in practice. It's pretty wild to think about.
Let's shift gears a bit for Section 4. Mechanics of trading units, how it works.
There are essentially 2 distinct pathways for trading this ETF, and it totally depends on who you are. For regular retail investors, it's highly accessible. You can buy or sell in lots of just one single unit directly on the NSE or BSE during normal trading hours. But for large investors and authorized participants, the mechanics completely shift. They trade directly with the asset management company, and they do so in bulk through what's called creation unit sizes.
And what exactly is that bulk size? Well, it's 65,000 units. That is the specific block size required for large investors dealing directly with the fund in exchange for portfolio deposits and cash components. This really highlights the massive scale of institutional trading going on behind the scenes. While everyday retail investors are trading single units back and forth on the exchange, authorized participants are effectively acting as wholesalers, creating and redeeming massive blocks of 65,000 units directly with the fund just to ensure the whole shebang runs smoothly and stays priced correctly.
And this brilliantly illustrates our final point today, Section 5, understanding the risks, the safety inspection.
So, according to the official regulatory documents, the riskometer for the Edelweiss BSE Top 10 Bank ETF sits firmly in the red zone. The documents explicitly state that both the scheme and the benchmark carry a very high risk rating. This is an impartial, mandated assessment based purely on the concentrated nature of investing strictly in equities within a single sector, which in this case is banking.
Also, because of real-world friction, passive funds experience what's known as tracking error. This is just the slight divergence of the fund's return from the underlying index. For this specific ETF, factors like transaction costs, brief periods of market illiquidity, and that small cash buffer we discussed earlier, well, they create a slight performance drag. However, the mandate explicitly states this tracking error is expected not to exceed 2% per year under normal circumstances.
Which brings us to the end of our structural breakdown of the Edelweiss BSE Top 10 Bank ETF. We've seen the strict passive strategy, the heavy concentration in just a few top banks, and the very high-risk nature of the portfolio. So the question I want to leave you with today is this. Knowing how tightly this fund locks on to a concentrated, very high-risk index without any active defense, does a strict passive banking blueprint align with your own personal financial education and portfolio goals? It is definitely a fascinating question to ponder. Thanks so much for joining me for this explainer today, and I really hope this deep dive brought some real clarity to the structure of passive banking ETFs.